Welcome to CFO Chat. This is a platform where we host the chief financial officers of various companies as and when they release results, and we're pleased to have Chemutai Murgor, who is the CFO at Standard Chartered Bank. Welcome on set. One of the things that stood out to me in the numbers that you've just released this morning is that we witnessed, unlike other banks, a slight decline in the interest income from government securities, considering the fact that majority of banks took a very cautious stance and were very positioning on that side. This was a bit intriguing, and I would just like to understand what exactly drove this trend that we have witnessed.
We invest, of course, across the various components of the government securities across the yield curve. So it depends really on your investment profile and when you invested and when they mature and how you reinvest that. So what I would say is when you look at the way we manage our balance sheet, the assets and liabilities, we manage it so that we are able to have liquidity available for our customers as they transact. They come for loans, they come and withdraw. So there is an element of managing liquidity as well as investing. So what I would say over the year, of course, you saw government securities, the yields came down. And so any maturities that you had obviously had a reinvestment risk. And also it depends on the risk profile. It could be certain people could go out maybe even up to 10 years or 5 years. So it depends really on how you manage your balance sheet. So in summary, I would say it was really because yields came down overall, and when it came to reinvesting, then you are reinvesting at a lower rate.
A loan-to-deposit ratio of 47%, down from 56% in the previous year, is a significant decline. And whereas we understand a very conservative position from the bank, the question then becomes what will drive the loan book growth in 2021, given the sort of numbers we have seen this morning?
Okay, so our AD ratio was 47%. We had a very strong growth in our liabilities, really a function of the strategy that we have. We want to be a collections and payments bank. So we've deployed the platforms that we have straight to bank. And that really has meant we have won new mandates. And also clients have given us a bigger wallet. So our deposits have really grown substantively, particularly on the current accounts and the savings. That is up 24%. Of course, the AD is a function of the assets as well. On the asset side, on a snapshot basis, which is December, obviously, that is down 6%. But when you look at the average balances throughout the year, and those are the numbers we look at, our assets are actually 6% up to 129 billion. So 6% growth in average assets in an environment like 2020, I think is commendable. Why do we have such a significant difference between the snapshot and the average? Is we are a corporate bank. Our clients do use their facilities, the limits we give them, and utilize them to fund their activities. And typically, for example, for trade, those are self-liquidating within 3 months, etc. So it's a timing difference in that essence in terms of utilization as well.
Now, talking about your assets, then, where do you see, which pockets of growth do you see driving your loan book agenda in 2021?
Of course, 2020, we spent a big time really revisiting managing the restructured portfolio. Our portfolio that was restructured was 21% of our total loan book, 26 billion. So we spent a lot of time really speaking with our clients, understanding what they were seeing, the impact on them of the pandemic, and really managing that portfolio. As we mentioned, for example, in the retail business, over 90% of those facilities were 3-month repayment holidays, and most of those have matured and gone into BAU. So looking into 2021, We expect some of the investments that our clients perhaps had put aside, some of those will begin to come back, and we should be able to support our clients in all segments, really, that we participate in. So we will go for those opportunities in 2021 as we see.
I see. Let's talk a little bit about the cost side. I saw rental charges went down to 216 million, down from 308 the previous year. Yeah. I'd imagine this speaks largely to the branch rationalization, or what exactly drove this?
Partially, and then of course also the way we have the right of use assets now. So last year was the implementation, and this year we're seeing the second year of implementation. Yes, last year we rationalized some of our branches. As you saw, the last 3 years, since 2017, footfalls have fallen on average by 47%. But in 2021, in some of the branches, as the CEO mentioned, the footfall has fallen by over 90%. So we are repurposing our branches so that we support our clients in this new way. But clearly, the 70 service journeys that we've migrated to the mobile app, with 62% of all those being done at the app now, most of our clients are not going to the branches for this period as well.
Okay. Going into the prudential section now, there was a proposed dividend, there was a recall. Just speak to us as to the degree to which then this was a prop up to your capital buffers as a bank.
Yes, of course, the pandemic broke out in Kenya March 13th. We were releasing our results on the 19th, you remember? So, of course, we had a good year, strong year in 2019. We had proposed a final dividend of 15 shillings to the share, and we had done an interim dividend. But obviously, with all these uncertainties, we felt that it was prudent to hold back some of that to tide us through the pandemic in case we needed it. So what we did is we varied our dividend and reduced it by 50%. That translated to 2.6 billion. And so that went straight to our capital, and that raised our capital ratio by 1.06%. So that was good. And then, of course, in the current year, we've managed. We've managed through the profitability, balanced it, obviously, with the dividend and the requirements going forward. Still being cautious. But also note, we've supported all our other stakeholders, so our investors are also important. So we have a very elaborate capital risk appetite strategy where we built in buffers, and therefore we are able to determine what buffers we require. So we therefore felt it was prudent to declare a 10 shillings and 50 cents dividend, compared obviously to the 12.5 per share last year, which is a reduction of 16%, compared obviously with the reduction in net earnings of 34%. What really has tided the Kenyan banking industry is we had invested a lot in some of the, prudential changes that came out of the global financial crisis. Yeah, of course, that's from an accounting area, but from the global financial crisis, banks put in capital conservation buffers. So our ratio for the industry was raised from 12% to 14.50. So that is a significant buffer, which is a buffer that you can utilize in a cyclical event. Second thing is the internal capital adequacy assessment process, which is really a stress test of your balance sheet and then of your capital. So we've done that process since 2013. So, and we've refined it. So this found us very well. We've continually stressed our ICAPs, and the central bank actually asked us in August to do another stress test, just focusing on the pandemic. So I think those two things really means banks now are able to really understand what drives their capital, and the likes.
And I must say, I saw a very, if I could call it, a very significant bump up in your loan loss provisions. The reality now is that we are grappling with what looks like a third wave, and no one is very certain what the next 6 or 12 months look like. Do you see a need for a further upward revision based on the way the business environment is unfolding, because pricing risk out there then becomes a bit of a challenge?
That's a good question. So we did a high-level review of the impact of the pandemic on our performance. We found out that in total, from that impact, the capital that we held back from 2019, which was 2.6 billion, actually covered it substantively. So when you look at 2021, obviously with the optimism that is there, that of course the vaccines will come through, we will begin to get this under control. Of course, the third wave is now in its height. We do feel that perhaps the worst is behind us. Of course, you can't say with certainty, but definitely what we saw last year was quite a challenging environment. So, and I explained that, for example, the IFRS 9 relies on models, and you put in macroeconomic variables, which are predominantly historic, and you try to make them forward-looking, so that you calculate the expected credit loss. Obviously, 1 in 100 events would not have been in our history, I guess. So obviously the models clearly were not generating the right levels of ECL. So what we had to do is, and this was done across, I mean, it's an accounting treatment that was done by most people, is you then had to put in a management overlay, which really tried to then capture that risk that was not coming through the models. So in our 3.9 billion loan charge, we factored in 1 billion of a management overlay to cater for that. So what do we see? When we look at our portfolio now, the indicators, especially in our retail business, where we had the large portion of the restructured, the key metrics are improving substantively. So as those ones improve as well, then they calibrate the ECL appropriately. So right now the portfolio indicators are improving, but obviously if a third wave comes that is significant and businesses get impacted substantively, that also comes through into the portfolio.
Okay. Wrapping up our conversation, bank shareholders are increasingly concerned that in view of the risks precipitated out there in the business environment by the pandemic, that the pricing by banks is not adequately capturing the risk environment out there, and for understandable reasons, that the pricing model is still, we understand, is still under review by the market regulator. But considering we have to be in a business continuity mode, what would you say really is the outlook from a pricing perspective?
I think following the rate cap, obviously, there were segments that you couldn't price in the risk. So I think there was a calibration of risk decisioning frameworks from the rate cap. So really where we are at now, those decisioning frameworks still serve us well. We definitely, I mean, the whole essence is we have taken deposits from other customers and we are lending it to other customers. So we have to really be careful that we lend to the right, we lend it and get it back. So we still, I mean, follow our risk decisioning frameworks and our risk appetites. Obviously, what the pricing models will allow us to do is obviously go after more customers with that higher risk profile. So we've really had good conversations with the regulator, reviewing our own model. Everybody has a different model, so they really have to review them in detail. And I think we are at the tail end of the process.